Welcome to the Intelligent Investing Podcast, where modern portfolio theory can suck it. A student of the School of Graham and Doddsville and a clergy member of the Church of Warren Buffett. Here's your host, Eric Schleien.
Hi, it's Eric Schleien. You're listening to the Intelligent Investing Podcast, and today we have back on Brian Dress, who is an investment analyst at Left Brain Capital. Brian, welcome back to the show.
Thanks, Eric. It's great to be with you again.
I would ask you what's new, but that seems to be a loaded question these days.
We're over here just, everybody's sheltering in place, of course. We're doing a lot of Zoom calls and pretty much rethinking every position we have in all our accounts and going from there. But we see a lot of opportunities out there today, so some good and some bad.
Yeah, well, I wanted to bring you back on. I know you have a knack, especially for looking at undervalued, cheap stocks, and also bonds as well. You look throughout the capital structure. So, we've been doing this coronavirus investment series, which has been the most popular thing in the history of this podcast. That people clearly have an interest in this. So I wanted to, on that theme, with coronavirus going on, what have you been looking at? Can you give us just like a general overview, and then we can get more into the weeds on kind of what you're seeing?
Yeah, sure. So when I was on your show last time, we talked about bonds and stocks, and it was a little bit of a struggle for us to come up with bonds to talk about because the spreads had gotten so tight. Even when you look down into the high yield and the B and the triple C tranches where the it's very low quality debt. So we were digging deep to find opportunities to talk to you, especially when we're looking at it through a value lens. And we're always looking for income opportunities for clients. So we were really digging deep to find anything where we could make 5-6% returns for our clients in the fixed income side, which is important for older investors and people in the retirement bracket. So like I said, high income securities back in those days were concentrated in a low credit rating basket in that triple C and some limited B opportunities. And the high coupon bonds that we're always looking for our clients were trading well above par. So that was the backdrop back then. And kind of what we're seeing now is a lot of the bonds that we followed or did work on, where we thought the prices were just too high back then, are starting to come into pricing situations where we think it's a little bit more favorable risk reward for our clients. And so that's where we are now. A lot of opportunities that we weren't seeing for maybe the last 3 or 4 years.
Right. Now, I mean, these tend to go in cycles, right? I mean, can you give us some of your just an understanding of how credit cycles have worked historically?
Yeah, sure. So, everybody's familiar with kind of the stock market cycle and recessions and how that all works. And, we see that sort of same thing in the corporate bond market too, but we see a lot more boom and bust cycles in corporate bonds than we do stocks. And that's because, bust, it happens in the recessions, when stocks have problems, bonds do too. But there's also times in between when, we don't have recessions, when we might be, more near to a recession or, just the bond market has a secular problem on its own, like 1991 to 3, 2011 to 12, and 2016. Where stocks didn't quite get into bear territory. So these credit cycles tend to be a lot shorter than what you see in the stock market. So every 3 to 5 years, you sort of see these flushes, kind of like what you saw this year. It's really important to have a contrarian approach when you're looking at high yield bonds in a portfolio context. When times are tough and it seems really hard to hit the buy button, that's when you got to do it. This is the time right now to load up on high yield bond issues and other corporates that are kind of in the lower investment grade area. You want to load up on those now, and then when spreads narrow, you want to lighten up the portfolio slowly and raise cash to take advantage of the next opportunity. So, within the next 3 to 5 years, we're going to see another one of these. You don't know why or how, but just expect that to happen. In our research in the general, high yield space, we've noticed that high yield outperforms stocks in recovery years. So, looking at 1982, 91, 02, 2008, and 2016, stocks did well in those years in general, but high yield tended to do better by 10 or 15% in each one of those years. So it's important to understand that, when you have big market routes, going into the high yield space is going to turbocharge returns.
Why do you think? Why do you think that is?
It's hard to say, but what we really think is liquidity is limited in high yield bonds. So when people are looking for anything to sell, the bids just disappear in this market. So a lot of times a high yield bond that's probably worth 70 or 80 might trade 50 or 60 in a situation like this. There's definitely a chase for yield that drives people down into lower quality credit. And oftentimes those people aren't really meant to be dealing in this market. And so when trouble comes, they just hit sell and ask questions later.
Right.
And also there are a lot of novel strategies that you see that develop in sort of low interest rate environments, and they use leverage and credit. And what we see kind of in the last 6 weeks or so is these leverage players in the risk parity game had to sell even stuff that was in the AA and A rated area just because they were so leveraged that 5 or 10 points down, even in AA or A bonds, they were forced to just sell. And so a lot of high quality credit sold off much, much more than you would ever expect.
Now, are the margin requirements different in bond portfolios than they are for stocks, or is it the same?
It's hard for me to say, how some of these hedge funds operate. But I think you can take a lot more leverage in bonds than you can in stocks.
Interesting.
Especially when the credit quality is a little bit higher. Mm-hmm. I think banks are a little bit more willing to allow you to take leverage and load up on those type of AA credits.
What's some of the highest leverage ratios you've seen in bond funds who are owning more high quality?
I don't have great visibility into that, but
Mm-hmm.
I was hearing sort of rumors of some of these guys are leveraged 5x or more.
That's insane. I mean, I guess it works in good times, right?
Yeah, most of the time you think, wow, this is a AA bond. What could ever go wrong?
No brainer, right?
And it's true. The company will never default. But, that doesn't mean you don't have to sell it. If it goes down 5-10 points, that means you're down 50 points.
Right. Yeah. It's interesting. So what's your overall general game plan in this environment?
The first thing you got to remember is, right or wrong, interest rates are going to be near zero for a long time going forward. And
you seem very confident about that. And I always get hesitant for anyone who's going to tell me where interest rates are going to be in a year or two from now. So what has you have that be such a high conviction view?
I guess I should say that, the federal funds rate will probably be really low for a long time. I can't tell you what's going to happen in the long end of the curve. But I just kind of look back to the last cycle, and 2008 was the last time they cut down to zero, and it took 7 years before they did a hike after that. So we're gonna operate as if that's what we expect for the next at least 24 months.
Okay.
So in that situation, like what we were talking about with income investment, it's going to be really hard to find those. So right now is the time to take advantage of how the market is playing out, because you're not going to be able to buy 8% coupon bonds at a discount for very long, because market participants are going to realize just what we're talking about. You're going to have to grab yield while it's here. So what we're doing is we're looking for high coupon bonds associated with stable companies, and some of those are even trading at a discount still. So like I said before, we've been starved for opportunities like this to, match up high coupon income opportunities with future cash flows for wealth clients. And we still see plenty of mispriced, underpriced securities out there. But it has to be said that a lot of the easy money's already been made. Some of these higher quality names in the AA, A, and triple B space have already narrowed quite a bit. Their spreads have already narrowed quite a bit. But we still see opportunities out here. But like I said, we got a chance to lock in some great coupons that align with future cash flows for clients. There's some high coupon bonds out there that have maturities of 2030 or later. So you can lock in some high coupon rates for a long time here.
Brian, I just want to stop you. Let's just dive into it. So can you just discuss a few names and that you're seeing in the debt markets?
Yeah, for sure. Speaking of what we were talking about with 2030 or later, I'm looking at a bond from a company called Q-Rate. The symbol's QRTEA. It's an 8.25% coupon bond for 2030. This is a double B rated company, and Q-Rate, you'd probably know it better by some of its brand names, QVC, HSN, and they have a few other online shopping type of businesses. This bond is trading around 80, so that implies a yield of about 12% annually going forward. But it was trading at 106 at the end of February. As we talked about, the star, everybody's star for yield. So a bond that's, yielding 8% coupon for more than 10 years is going to trade at a premium. So we think there's a really solid opportunity for a capital gain in Q-Rate, 8.25%. And not only that, you're able to lock in, a very nice rate of return on the income side for about 10 years here.
Now, are these all businesses? Are these all businesses where you've looked at the balance sheet, you've looked at the column, and you say, okay, the risk of not being able to pay on these bonds is pretty slim to none? Would you go that far?
Yeah,
because if they can't pay, then all this doesn't really matter.
100% true. So just to kind of back up and look at how we're looking at things from more of a 30,000 foot view is
perfect.
Right now, fortress balance sheet is an imperative. You're going to have a strong balance sheet to get through this probably. In a lot of bonds that we look at, we're just going to go ahead and assume zero revenue for 2020. I don't know if that's going to be the case or not, but we're going to take that as an assumption and then stress test the companies against that scenario and see, can they survive this next, 12 months? Because we think, at some point things are going to go back to some sort of normal. But can you get through this short-term pain here? So, on shorter-term maturities especially, we're looking for companies that have cash to cover the maturities. So they don't have to go out and find some sort of refinancing transaction to pay off existing bonds. So a lot of these bonds that we're looking at or putting in have that situation where it's like, they have enough cash or sort of revolving credit capacity to cover whatever maturity we're talking about. On Q-Rate, the business case, all their fulfillment centers are still operational as of the end of March. Like I said, there's no maturities due until July 22 for $500 million. So, hopefully we'll be back to some sort of normal before then. They have more than $3 billion in liquidity, so they can cover those maturities in 2022 and 24. They're a company that's generated $1 billion of free cash flow for 10 years running, and there's pretty minimal capex needs for this business. And then the final thing that we like is the CEO purchased 550,000 shares in early March with cash from his pocket. So there's a lot of good things going for Q-Rate, in addition to sort of the income opportunity.
Interesting. And what else? What else? Can you give us a few more names?
Yeah, I got a couple more. This next one's a pretty contrarian play, I would say.
Okay.
It's Illinois 5.1% general obligation bonds that mature in 2033. I think it's been pretty well noted in the financial media that Illinois has a pretty questionable fiscal situation.
Yeah, they just have a few problems, right?
Yeah. And most of it is unfunded pension liabilities and that sort of thing. We're actually based in Illinois, so this is interesting to us on that level. But we kind of looked under the hood of Illinois. And first of all, I want to tell you, these bonds are trading around 96. They were trading 118 before all this happened, so a month ago, or a month and a half ago. At the current level of yield, these are tax exempt bonds. This bond's going to yield you more than 9% at the current levels. But we looked under the hood of Illinois' finances, and we were actually a little bit more heartened than we expected to be. First thing is, there's a lot more capacity to raise revenues here. The current state income tax rate is 4.95%, which might be high to people that live in low tax states, but it's much lower than the income taxes that you see in California, New York, New Jersey, Connecticut, and other states like that are high tax. So we think there's more capacity to raise taxes here and raise revenue. There's a ballot referendum coming in November that would amend the state constitution to allow progressive income taxation. At the current situation, the only opportunity is a flat tax. So if this passes, this would raise an estimated $3.6 billion in additional annual revenue. The state has to balance its budget every year, but it has an accounting trick that's called a bill backlog. It's sort of an accumulated debt account. 3 years ago, it was $16.6 billion. Today, it's at $7.6 billion. So the state comptroller, Susana Mendoza, has really done a good job of bringing that under control. So from that point of view, we think the situation's not terrible in terms of the financials. And then also, the Fed announced it would buy municipal bonds. So that's a backstop to any investors in this bond. And also, S&P and Moody's put out a report recently saying it doesn't expect any municipal defaults as a result of what's going on now. And no states have defaulted since World War II. So I think we got history on our side here, too. But I would say I wouldn't rush to get in a full position right away. We wouldn't be shocked if this bond traded down 5 or 10 points from where it is now at 96. If broader markets sell off at any point in the next few weeks. So, it might be worth thinking about doing a starter position here and then retaining some bullets in case it does trade down a little bit in the next few weeks.
Interesting. And then what else do you got for us?
Okay, this is another contrarian area. Travel and leisure. If you just think about it on the common sense level, it seems terrible. Like, there's no way these travel companies are going to be able to survive the next few quarters of really almost zero revenue.
Well, some of them may actually not survive.
Yeah, you're right. You're absolutely right. So it's different in every case. So the airlines, we feel really good about their survival, at least in the near term. It seems like the government is very committed to maintaining the airline infrastructure in the country and considers it an essential business. So we're looking at...
So, let me just ask you, Brian.
Yeah,
I think that's probably not a contrarian view, but how do you ensure that, say, like the equity doesn't get wiped out, or there isn't, some weird thing that, that happens if the government, takes a stake or takes it over, that you guys don't get screwed in some way?
Yeah, well, we wouldn't be playing in the equity on these at all.
Okay.
It seems like whatever came out a couple of days ago, I think there's going to be some warrants where the government can buy in at certain levels, but it doesn't appear that they want it. I think if they were going to do that, they would have done it already. Mm-hmm. So on the bond side, we're looking at Delta. They have
to be clear, you don't see any government intervention having an impact on the bond side?
No, we really don't.
Okay.
I think it's just it actually bolsters the position of bondholders. So we're looking at that 4 3/8 bond. That's a 2028 for Delta.
Okay.
And I would say on these travel and leisure, they have narrowed quite a bit. So this is more of a kind of watch list item. If these things trade off, might be a really good opportunity. I wouldn't say go steaming in right now, but that Delta 28 yields around 6.6 at current levels. Like I said, we like the risk reward a little bit lower. It's trading 86 right now, so if it gets down in the high 70s, low 80s, might be worth jumping in right there.
Where was it trading before all this, COVID-19 stuff started happening?
I believe it was above par.
Was it? Okay.
Yeah. So this is what I was talking to you about, where we're talking about what is the liquidity situation, assuming zero revenue. We've done that analysis on Delta. Right now they have $6.2 billion of liquidity before government intervention. So that's $3.1 billion in cash, $3.1 billion of credit capacity. They just announced yesterday that federal relief package is going to be for $5.4 billion. So that gives a total liquidity of about $12 billion. The next maturity is $600 million in April 21, and their pensions are fully funded until 24. So that's a positive in their case. And so we've done a worst case scenario analysis on Delta pre-federal intervention, and at their current rate of cash burn, we'd be talking about a negative $400 million of liquidity at the end of 2020. So when you factor in that $5.4 billion, we feel very confident they're going to make it through 2020. And, 2021, hard to say what it's going to be like for the airline industry. But the reality is we think there'll be another aid package if things are, still like they are now. So we feel pretty solid with those. And then there's one other, this is really contrarian, I believe. Carnival
Cruise liner? Okay, yep.
Yeah, Carnival Cruise. There's a 2020.
I can hear it in your voice. This is really contrarian.
It's a little, this is another one like the Illinois bonds where we, when we first looked at it, I was like, there's no way we'll ever get involved with this. But there's a 2020 bond for Carnival that is maturity in October. It's currently trading just a few points below par. But so that gives an annualized yield of around 8% on the 2020s. Okay. We wouldn't buy it right here, but if you look at if it prices down in the low 90s, you're talking about an annualized yield of more like 25%. So that's completely different kettle of fish.
Right.
What really piqued our interest in Carnival was the fact that they were able to raise $6 billion. Like I thought there was no way they would be able to go into the capital markets and do anything. So that just totally changed our viewpoint. We did that scenario analysis on these guys. They're about $1 billion of cash burn per month. So consider that their liquidity is about $12 billion after they did this $6 billion cash raise. That's more than enough to get them to this October maturity. So we feel really strongly about that one. But as again, at 8% yield, it's not really worth doing. But, if it comes down to where it's yielding more like 25%, definitely worth considering. And then there's one other bond in their stack. It's not available to retail investors. So if you have any institutional investors listening here, this might be of their interest to them, is that 2023 secured that they just issued. That is an 11.5% coupon. These bonds are secured by the ships that they own. So we did the analysis, and if these guys go bankrupt and have to sell their ships at 40 cents on the dollar, it would be a full recovery for secured bondholders.
Interesting. And where do those trade right now, the 2023s?
They're actually trading slightly above par.
Okay.
So when they did the issuance, it was about $4 billion of issuance. They had over $17 billion of bids for these bonds.
Wow, that's a little surprising. But I guess because they're secured, people were, you have a combination of something secured by actual ships plus a 0% interest rate environment.
Yeah, an 11.5% coupon.
Exactly.
Really hard to turn away from.
Right.
So, so that, again, I would never tell anyone to buy the equity in these travel companies, but definitely some interesting opportunities in the bond side.
Really interesting. Well, I think we should end it on that note, but I know you, before we finish it up, you're debuting a new service, right, at your company?
Yeah. So,
can I ask you about that?
Yeah, go ahead.
Yeah.
Sorry.
Yeah. Just tell us. I would love to hear what you guys are doing.
Yeah. So at Left Brain, we have, we have our wealth management business, we have our hedge fund, but we also have an investment research service. It's called Left Brain Investment Research.
Okay.
We got a couple of good things going on right now. A couple of shelter-in-place specials. The first is we have our full research product, and we're willing to offer that to all your listeners with the promo code ERIC for $99 a month.
All right.
And our research product.
I want to also just make a full disclosure. I had no idea about this promo code until just the second, and I don't get any reimbursement for this. So this is completely Brian just telling me this for the first time right now. So just full disclosure.
Thanks, Eric.
Yeah.
So you can find us on www.leftbrainir.com. Our research product features long-form reports on stocks and bonds. We have these reports that we call quick looks, which is just quick and dirty looks at companies that we write up when we have to make quick decisions on companies, and opportunities just come across our desk, and we got to do this quickly. And then we also have earnings updates that come out each quarter for quite a number of companies. So that's our research product. And then we're doing a brand new service, which is some pay-per-view seminars, and we're debuting on April 23rd and April 30th. We're going to do hour-long Zoom discussions about our best bond and stock idea on the 23rd and the 30th, and all the research that goes into that. We're going to include input from our entire investment team, including our CIO, Nolan Langford, along with opportunities for listeners to do Q&A on those seminars. So I think it'll be really interesting. I've never seen anything like this out in the market. We'll have to see how it goes, but you can find information for those seminars on the front page of our website, again, at www.leftbrainir.com.
And we'll put all that in the show notes as well. All right, great. Well, Brian, is there anything else before we finish up?
No, just hopefully everybody's doing well out there, staying safe and healthy, and we'll get through this soon enough.
Exactly, yeah. Well, Brian, I really appreciate you coming back and sharing your thoughts and ideas and being so generous with that too. So, stay safe, and hopefully next time we have you on, we'll all be out of quarantine.
Thanks a lot, Eric.
All right, sounds good. Have a good one.
Thank you for listening to the Intelligent Investing Podcast with Eric Schleien. If you'd like to connect with Eric for questions, comments, feedback, ideas, or to inquire about being on the show, please contact Eric at intelligentinvesting@gmail.com. So, in the words of Charlie Munger, I have nothing to add.